So glad that you are interested in learning a little bit more about investing, and I'm so grateful for this opportunity to continue sharing the story of how we get there by understanding small business. If you want to be a better investor, you really do yourself a great favor by understanding small business, and that's the reason that I have been creating this series of courses that talk about how do you build a small business. I did not choose to build my prosperity with small business, but I had a very good understanding of how they operate, and it is for that reason that I was able to go from nothing to building assets worth several $1 million within 5 years of finishing 26 years in prison. And that's what I am striving to teach to you, to anybody who is visiting the michaelsantos.com family or network or community. It's my goal to try and help those people build more prosperity. And I'm specifically creating this series of courses for young people who are contemplating taking on tens of thousands of dollars of student loan debt, or for individuals who are living in struggle that may want to find out what are some of my other options. I talk a lot about needing to think differently, and I taught myself or learned how to think differently by studying leaders during the 26 years that I served in prison. I read a number of business books and philosophy books, government books, just books on leadership and management, and all of that put me on the pathway of thinking differently. Not thinking like the herd, but rather thinking about what is the best possible outcome. And that's what we're doing. That's what I'm striving to do with this series of courses on becoming a better investor. And to give you a recap, this is what our balance sheet looked like for Michael's Hot Dogs. That was the name of the fictional business that we started, right? Michael's Hot Dogs. Was a very simple business. I formed it as a corporation, and I sold 500 shares to an investor. That's reflected in here in the cash. And I took on $250 in debt, and I kept 1,000 shares, which is the goodwill right here. But then I took those assets and I started to buy fixed assets, which is a hot dog stand. And I also invested in some inventory, which is the hot dog buns, the hot dogs themselves, condiments, everything that I would need to get this business rolling. And altogether, I'm left with this balance sheet, which still shows on paper the business has $1,500 in shareholder value. But now the business is really ready to start rolling because we have our hot dog stand and we have our inventory. We've got a little bit of cash. We are ready to start rolling. We are ready to start operations. But we have to continue recording what those operations look like, and that's why we take a look at the financial statement. We take a look at the income statement, otherwise known as the P&L. And for the sake of this case study, I've made some assumptions about our first year in business. And the reason I did that is I wanted to show what is our income statement going to look like? What does success look like after the business has been operational for a year? So for the purposes of this exercise, I'm trying to keep everything really simple, and I'm going to use some really low dollar amounts with the assumption that it will make things easier for us to follow along on a component of the financial statement that some might find a little bit complex. So we're going to use some simple metrics here, and in our first line that we're going to enter, we're going to talk about what our sales look like. And we had one hot dog stand, and that one hot dog stand sold 800 hot dogs at $1 each. Okay? Pretty cheap hot dogs, not a whole lot of volume. Did it on one stand. Maybe we were only open for an hour a day, but at the end of the day, during this time period, we sold 800 hot dogs. And we sold 800 hot dogs for $1 a share. So now we have got what's called an income statement, because we're going to record every single entry of business that Michael's Hot Dog Stands does. And our simple model shows that we generated sales in business, sales or revenues of $800. Okay? That's what the income statement shows on the top line of revenues. But we have to continue going because the revenues do not equate to profits. That's just the sales. right? We also have some costs that we have to take into account, and so our income statement is going to take some assumptions. Let's talk about what are the expenses, right? The expenses include, okay, $530 in labor, because that hot dog stand had to be manned, and that labor to man that hot dog stand cost us $530 over the course of time that we're recording this income statement. So now we have an assumption of revenues, we have an assumption of labor, and this is what we're going to use to start building our profit and loss statement so that we can see how did the business perform. This is what helps us determine whether we have a good business or not. And so the income statement differs from the balance sheet because the balance sheet tells us about assets, liabilities, shareholder equity in the company. The income statement, by contrast, or the P&L, right? The P&L tells us, well, are we performing okay as a business? How is it doing? And we can kind of take a look at this from this $800 in sales and $530 in labor costs. We've got an essential start to get going on taking a look at as a snapshot of how this business is operating. But we've got a few more expenses besides these cash expenses. If we're executing our business model appropriately, we have got to recognize that we've got other expenses that we need to take into account. So we had our sales of $800, we had a labor expense of $530, we had depreciation of $60, which we have to hold into account as well, because our hot dog stand, that fixed expense that we purchased for $300, remember we said that it was going to depreciate over 5 years, and we were going to straight line depreciation off of it, just taking $60 off. This is a non-cash expense, but it's still an expense. It still shows up on our P&L because we've actually spent that money. We're depreciating the asset over a period of time, and so that's got to be reflected on our P&L. So we do show the $60. And the income statement, as I said, it also shows our labor expense of $530, which is the expense we generated to sell the 800 hot dogs. So with expenses for depreciation, and we also have inventory, right? I forgot about that. We depreciated our inventory, which we had to replenish. So we had expenses for depreciation as well. So that's a total of $530, $630, $730 plus $60. That's total expenses of $790. But remember, this is non-cash. I don't know if you can read my sloppy handwriting, but that's non-cash. That's just money that's getting set aside. But at the end of the day, we still had $790 worth of expenses on $800 in revenues. So our income statement will subtract this $790 from this $800 to give us the sum total of our gross profit. So we earned a total of profit before, this is pre-tax profit, also known as earnings before interest and taxes. We had profit of $10, because that's a subtraction that comes from there, right? So we had profit of $10. That's right, for all of our work, for an entire year, we earned the sum total of $10. So we didn't make much money if we take our pre-tax profit and we compare it to our revenues. I can do a very simple formula and see that we only have about 1.3% profit margin. And we arrive at that 1.3 profit margin by taking our $10 and dividing it by the $800 here. That equals 1.3% profit. But wait, there's more. Because remember that we also have an interest expense. We borrowed $250. That's a liability. And we've got to pay $25 in interest every year for that. So regardless of how well we're doing, our debt holder expects to get paid, and we're going to have to pay him his $25 that he is owed. So that is also going to come off of here on our income statement of $25, which is going to leave us with a negative $15. So we took a loss of $15 on our first income statement during our first year. Now, fortunately, we don't have to pay any tax because we didn't make any money. You only pay tax if we make money. But when we are making money, we should budget about 35% of the money that we earn is going to go to taxes. So at the end of the day, Michael's Hot Dog generated a gross loss of $10. And if we divide that per share, we end up losing about a penny a share for each of the 1,500 shares that are outstanding. So on the surface, it may not look like we have a very good business, and we need to make some assessments right now. What should we do? We've worked for a year and we've lost money. Is it time to give up, or is there something else that we are going to have to do? And what I'd like to do right now is take a look at that in the next video. Let's take a look at what we did and make a determination on how well this business is moving and whether we should make some changes, even whether we should maybe even keep this business afloat. We have got to look at our investment from a disciplined perspective. We know that what we started with, and we know that we just lost $15, and it's going to be time for us to either make some changes or keep rolling. And that's what we're going to discuss in the next video. I am Michael Santos. I want to thank you for sticking with us on this course on investments. I do believe that understanding small business will help make you a better investor. And if you stick with us on the next video, we will talk about some of the assumptions that we have to make after we look at this hard data.